Hello and welcome to my YouTube channel. In today's video, we're going to learn on IAS 28, Investment in Associates, looking at definition and how we account for it. Under IFRS, when a company or an investor holds between 20% to 50% of the voting rights of an investee company, which is an associate, either directly or indirectly through subsidiaries, it is presumed that the company has or can exercise significant influence but not control over the investee business activities. All right. Conversely, if the investor holds directly or indirectly less than 20% of the voting rights of the associate or investee, it is presumed that the investor cannot exercise significant influence unless such influence can be demonstrated. Furthermore, on IAS 28, this applies to most investments in which an investor has significant influence. It also provides guidance on accounting for investment in associates using the equity method. The standard note that significant influence may be evidenced by any of the following. The first is company's representation on the board of directors of the investee company, then participation in the policy-making process in the investee company as well. Also look at material transactions between the investor and the investee company, any interchange of managerial personnel, that is, if the investor is providing managerial personnel to the investee company, you need to consider that as well, and if there's any technological dependencies. All right, so these are factors to consider to assess if the investor have significant influence over the investee company or associate. Then furthermore, on IAS 28, under the equity accounting method, what are the basic principles we need to be aware of? The first principle is that under the equity method of accounting, the equity investment is initially recorded on the investor's balance sheets at cost. Alright, so at the point of initial investment, you recognize this amount at cost. Part B says, in subsequent periods, the carrying amount of the investment is adjusted to recognize the investor's proportionate share of the investee's earnings or losses, and these earnings or losses are reported in income. Also, dividends or other distributions received from the investee are treated as return of capital and reduces the carrying amount of the investment, and those dividends should not be reported in the investor's profit or loss. The equity method is often referred to as a one-line consolidation because the investor proportionate ownership interest in the assets and liabilities of the investee company is disclosed as a single line item as net assets on its balance sheet. And also the investor's share of the revenues and expenses of the investee company is disclosed also as a single line item on the income statement, which companies may have it as share of profit or loss of the associate. Also, in the equity method, investments are classified as non-current assets on the balance sheet. So to quick help us with a decision rule or decision tree on how to assess if a company has significant influence over the investee company and the application of the equity accounting method, here are the following steps or questions that we need to answer. The first question being that, does the entity have control over the investee company? If it's a yes, means that you cannot account for this investment based on IAS 28. You need to prepare a consolidation based on IFRS 10. So if there is no control, then you need to ask yourself the next question. Does the entity have joint control with another company or entity? If it's yes, then you need to account for this investment based on the joint arrangement under IFRS 11. If it's no, you then need to ask the following question as well. Does the entity have significant influence over the investee company? Thank you for watching, and see you in my next video on the application of the equity accounting method in practice. Bye.